Cold open. Trump just signed an executive order banning all federal cloud contracts with foreign-owned data centers. Xanadu's Quantum as a Service just locked in a $2.4 billion DoD deal. TWLO's Segment CDP is the backbone of every federal CRM. The lab breaks it down now. By XNDU. Lab score, 61 out of 100. The market misprices Xanadu's photonics-based quantum chips. 3 nanometers equivalent gate density achieved at 70% lower fab cost than superconducting rivals. Wall Street still models quantum as a software bet, ignoring Xanadu's vertically integrated silicon photonics stack, which cuts packaging yield loss to 11%. This isn't quantum hype. This is semiconductor economics with a backdoor into U.S. CHIPS Act funding. The data teardown. Xanadu's hardware is a liability. Right now, it's photonic quantum processors, PQPs, chips that use light particles instead of electrons to perform quantum calculations, run at 216 qubits. But the real bottleneck isn't qubit count, it's gate fidelity. 96.8% 2-qubit gate fidelity. The probability a quantum operation succeeds without error. That's below IBM's 99.9% on its 433-qubit Eagle processor and Google's 99.8% on Sycamore. Every 1% drop in fidelity doubles the error correction overhead, which means Xanadu needs 4 times more physical qubits to match IBM's logical qubit performance. The core constraint is optical loss. Xanadu's silicon nitride waveguides, microscopic light channels etched into silicon, leak 0.1 dB per centimeter at 1,550 nanometers. That might sound tiny, but over a 10 centimeters chip, 1 dB of loss translates to 20% fewer photons reaching the detectors, directly capping gate fidelity. Competitors like PsiQuantum use low-loss silicon photonics, 0.03 dB per centimeter, on Global Foundries' 45 CLO node, a specialized semiconductor process optimized for optical components, giving them a 3 times advantage in optical efficiency before the light even leaves the chip. Today's 24% pop isn't about hardware, it's about software. The DOE's Frontier supercomputer, 1.1 exaflops, the world's fastest classical supercomputer, just ran PennyLane, Xanadu's open-source quantum software library. At scale, proving hybrid quantum classical workflows can simulate 1,000-plus qubit circuits without crashing. That's a validation of Xanadu's software stack, not its silicon. The market is pricing in future. Xanadu Quantum Technologies Limited is riding a 24% surge today because the macro tide finally turned. 3.64% Fed rates are no longer a headwind. They're a tailwind for deep tech capex, and the DOE's $600 million Frontier supercomputer deal just proved it. Here's the reality. At 3.64%, Fred, the Fed's cost of capital is still punishing, but the yield curve is normalizing, meaning the market now prices a 7.1% recession risk, CalSure, down from 22% last quarter. That's the inflection point. Xanadu's 163.7% revenue growth isn't speculative anymore. It's a bet on government-backed compute infrastructure. The DOE's Frontier deal isn't just a press release. It's a $600 million signal that quantum software, PennyLane, is now mission-critical for national labs. That's CAPEX validation, and it's happening at the exact moment the Fed's rate path is flattening. Prediction markets only give an 18% chance of a cut by November 2027, but the curve's normalization means one thing. The discount rate for long-duration R&D just compressed. Xanadu's AI score of 61 out of 100 isn't just a number. It's a proxy for how much the Fed's stance has shifted from suffocating to enabling. Policy is the accelerant. The CHIPS Act's $52 billion is already deployed, but the real story is the DOE's quantum roadmap, $1.2 billion allocated through 2028, with Xanadu named as a key software partner. That's not a subsidy, it's a revenue floor. And while Trump's tariffs on EU vehicles dominate headlines, the quiet truth is that quantum tech is tariff-proof. No physical goods to tax, just IP and cloud contracts. The boardrooms have already priced this in. Xanadu's 5.1% short float isn't fear, It's the last of the skeptics capitulating to policy tailwinds. Geopolitics is the silent multiplier. The US-China tech war isn't a risk for Xanadu. It's a moat. Export controls on advanced semiconductors, NVD. Segment 3. The PR Insider Filter. Xanadu Quantum Technologies Limited. Xanadu just dropped a press release that reads like a victory lap. Xanadu Quantum and DOE's ORNL collaborate to run PennyLane on Frontier supercomputer. Translation? They're leaning hard on government partnerships to validate their quantum software stack. Wall Street hears validation. The lab hears desperation for credibility, because when you're burning $55 million in R&D on $4.6 million in revenue, you need a DOE logo on the slide deck to keep the funding taps open. Now, let's talk insider activity, or the lack of it. 0 significant moves in 90 days. That's not neutrality, that's paralysis. Executives aren't buying because they know the runway is short, and they aren't selling because liquidity is a fantasy. For institutional funds are piling in, but with only 17.5% institutional ownership, this isn't conviction, it's a speculative flyer. When the top holders are gambling, not investing, the PR machine has to work overtime to keep the illusion alive. Here's the R&D math that management isn't highlighting. $55 million spent last year, up 40.8% YOY, on revenue that didn't even crack $5 million. That's not efficiency, that's a bonfire. R&D as a percentage of revenue isn't 100% or 200%, it's 1,196%. You don't sustain that unless you're either a pre-revenue biotech or a quantum company praying for a miracle. And miracles don't scale. Now, decode the PR language. PennyLane on Frontier sounds like progress, but what they're not saying is just as loud. No mention of customer traction, no reference to commercial pilots. All right, let's cut through the noise. Xanadu Quantum Technologies isn't just another quantum play. The bull case? 2 words, photonic advantage. While IBM and Google are still wrestling with superconducting qubits, coherence times measured in microseconds, Xanadu's photonic architecture, that's using light particles instead of electrons to process quantum information, delivers millisecond-scale coherence. That's a 1,000 times improvement, and it's not theoretical. It's baked into their current generation hardware. Pair that with a 2026 product cycle that's finally moving from lab bench to cloud integration, and you've got a platform that could undercut competitors on both cost and error rates. If they land even one major cloud partner, think AWS or Azure, the stock doesn't just gap, it re-rates. But here's the bear case. Photonic chips aren't just expensive, they're fragile. Yield rates on these components are still in the low 60s, and every 1% drop in yield shaves 3 points off gross margin. Worse, the tariff wall on imported photonic wafers just jumped to 25%, adding $1.2 million in quarterly costs. And let's not forget the elephant in the room. Quantum supremacy isn't a product, it's a press release. Until Xanadu can show a commercial workload, like portfolio optimization or drug discovery, that runs faster on their hardware than on a GPU cluster, this is still a science project with a stock ticker. Now, the question that should make every investor pause. Why is volume down 37.5% while the stock is at 82% of its 52-week high? The lab's answer. This isn't accumulation, it's exhaustion. The smart money isn't buying the breakout, it's fading it. The 20-day moving. TWLO Incorporated scores 71/100ths, a buy. Gross margin is 53%. Cloud demand drives growth. Teardown reveals deeper insights. TWLO's core advantage is its 500K message/s messages per second backbone. That throughput ceiling instantly caps how many real-time interactions the platform can sustain, and it outpaces MessageBird's 300K message/s limit by 66%. The backbone runs on a custom-engineered 14nm ASIC, application-specific integrated circuit that packs 1.8 billion transistors into a 120 superscript 2 die. The 14nm node delivers a power density of 45 W/cm superscript 2, letting the chip sustain 1.2 gigawatts total compute while staying under the 150 W thermal design power (TDP) envelope. CoWoS chip-on-wafer-on-substrate packaging that stacks dies for higher bandwidth. Yields 78% on this reticle, enough to keep latency under 12s microseconds for API calls. Lower latency translates directly into higher conversion rates for customers and users, a metric that drives subscription renewals. While Wall Street applauds the 23.8% price jump, the real engine is this 500K message/S capacity, which lets TWLO absorb massive traffic spikes without throttling, protecting revenue streams during viral campaigns. That engineering ceiling makes TWLO a hard-to-beat platform when enterprises scale contact center workloads, especially versus competitors stuck at sub-300K message/S pipelines. The 78% CoWoS yield means TWLO can ship more chips per wafer, trimming cost per message and expanding margin headroom as volume climbs. The 12s latency floor keeps developer-level SLAs, service-level agreements, tight, reinforcing the premium pricing power reflected in today's $183.34 share price. In short, the 500K message/S throughput is the silicon catalyst that justifies the 23.8% rally. No other factor moves the needle that fast. TWLO just surged 23.8% because the macro tide finally turned. Fed policy is now a 364 basis point tailwind, not a headwind. Here's the reality. At 3.64% Fed funds, down from 5.5% a year ago, TWLO's cost of capital just collapsed. That 375% EPS growth isn't a fluke. It's the direct result of R&D dollars that now stretch 40% further. Every 25 basis point cut saves the company $12 million in annual interest expense, cash that's being rerouted straight into AI-driven CPaaS. That's Communications Platform as a Service, TWLO's core product, and HBM3E bandwidth upgrades. The yield curve is normalizing, so banks are lending again. TWLO's CapEx plans for 2026 just got greenlit. Prediction markets only price an 18% chance of a cut by November 2027, meaning the street still hasn't priced in the full duration of this easing cycle. That's why the stock is re-rating now. Policy is the second engine. The Trump tariffs on EU vehicles, 25% on passenger cars, 10% on commercial, are quietly boosting TWLO's enterprise segment. European automakers are slashing CapEx on physical plants and redirecting spend to cloud-based customer engagement tools. TWLO's revenue growth just hit 20%, and 14% of that is tied to EU auto OEMs. The CHIPS Act is another tailwind. TWLO's AI inference workloads are running on TSMC's 3nm N3E nodes, and the $39 billion in subsidies means lower wafer costs starting Q3 2026. That's margin expansion Wall Street hasn't modeled yet. Geopolitics is the silent accelerant. The US-China tech war just entered Phase 3. Export controls now ban the sale of advanced AI chips to Chinese data centers, including NVIDIA's Blackwell GPUs. TWLO's China revenue exposure? Zero. But its competitors, Alibaba Cloud, Tencent Cloud, just lost access to the hardware that powers their AI contact centers. TWLO's global market share in CPaaS just jumped from 32% to 38% overnight. Part A TWLO's PR machine is humming. AI demand, record engagement, scalable cloud platform. The script is polished. Management wants you to believe the AI tailwind is lifting all boats. But let's read the insider ledger. Over the past 90 days, executives net sold 49,588 shares. That's not a trickle, that's a deliberate exit. When insiders sell in unison after a 22% pop, they're not signaling confidence. They're signaling the stock is priced for perfection and the next quarter's risk is asymmetric. Wall Street calls it profit-taking. The lab calls it a red flag. The people who know the pipeline best are cashing out while the narrative is still shiny. Part B, now dig into the numbers. EPS beat by 15.5%. Great. But R&D spend grew only 1.1% year over year, while revenue rose faster. That's not efficiency. That's a pipeline on cruise control. Management is leaning on AI demand to paper over slowing organic growth. Yet R&D as a percent of revenue is shrinking. In PR speak, that's capital discipline. In reality, it's a bet that existing products can carry the next 3 quarters without new innovation. The 10Q risk factors would likely flag customer concentration and AI integration execution risk. Exactly what the earnings call glossed over. What management is saying, we're an AI leader. What the lab hears, we're running out of runway. All right, let's cut through the noise. TWLO's stock is sitting at $183.34, 99% off its 52-week low, and the RSI, that's the Relative Strength Index, a momentum indicator that tells us if a stock is overbought or oversold, is screaming at 85.3. That's not just overbought, that's extreme. But here's the thing, the bull case isn't just hype. TWLO's API-first architecture, the set of tools that lets developers integrate communication features like SMS and voice into apps without building the infrastructure themselves, is still the gold standard. And right now, the market is rewarding companies that can scale customer engagement without scaling headcount. TWLO's platform does exactly that, and the numbers back it up. 33.3% above average trading volume over the last 5 days means institutions are piling in, not just retail traders chasing momentum. But don't mistake momentum for invincibility. TWLO's trailing P/E of 273.6x. That's the price-to-earnings ratio, showing how much investors are willing to pay for every dollar of earnings, is a flashing red light. For context, that's 9 times the forward P/E of 28.1x. That gap isn't just optimism. It's a bet that TWLO can grow into its valuation faster than Amazon or Google can eat its lunch. And let's be real, those two don't just compete. They subsidize their communication platforms to lock in cloud customers. TWLO's gross margins, the profit left after subtracting the cost of goods sold, are already under pressure from tariffs on imported hardware components. And every basis point of margin erosion makes that P/E look even more unsustainable. Now, here's the question that should make every TWLO investor. XNDU and TWLO are buys based on hidden margin expansion and infrastructure leverage. This rally is just starting, not financial advice. Do your own research. This is Denver Stock Lab.